Right now, the Internal Revenue Service is quietly rolling out 5 massive rule changes for the year 2026 that will directly target the money you have spent your entire life saving. If you are anywhere near retirement or already living in it, ignoring these shifts could accidentally push you into a devastating healthcare subsidy cliff, trigger unexpected penalties, or force you to pay thousands in unnecessary taxes. But there is a massive silver lining, because buried inside these new 2026 tax codes is a hidden loophole that could legally protect your nest egg if you know exactly how to use it. We are in a completely new financial landscape. You've likely spent decades playing by one set of financial rules, diligently putting money away, assuming the finish line was going to look exactly the way it did for your parents. But Washington has fundamentally rewritten the playbook. Back in 2022, Congress passed sweeping retirement legislation, and while they loudly celebrated the immediate perks, they intentionally delayed the most punishing and complex changes until 2026. Well, 2026 is officially here. I have spent years analyzing the tax code to protect retirees from exactly this kind of legislative bait and switch. And my goal today is to give you the exact defensive strategy you need. Over the next few minutes, we are going to walk through each of these 5 critical changes. I'm going to reveal the specific tax trap targeting higher earners first, because it requires immediate action on your part. Then we will work our way through the new deduction rules, the updated catch-up laws, and finally the most dangerous hidden trap of all, a healthcare cliff that could cost early retirees tens of thousands of dollars overnight. Let's protect your money. Let's start with a change that was designed to sound like a benefit, but operates exactly like a tax trap for anyone who is still working and trying to sprint to the retirement finish line. For years, the conventional wisdom for older workers was simple. As you hit your peak earning years, you should max out your pre-tax retirement accounts. The government even encouraged this by offering catch-up contributions for anyone age 50 and older, allowing you to shovel thousands of extra dollars into your 401k to lower your taxable income right when you were in your highest tax bracket. It was a beautiful, predictable system that saved families a fortune in taxes. But as of January 1st, 2026, the IRS has slammed the door on that strategy for a massive portion of the population. The tension here is that the government desperately needs tax revenue now, not 20 years from now. So they buried a provision in the Secure 2.0 Act that fundamentally changes the nature of catch-up contributions. If you are 50 or older and you earned more than $150,000 in the prior calendar year, you are completely stripped of your ability to make pre-tax catch-up contributions to your workplace retirement plan. Think about what that actually means for your paycheck. Starting this year, if you cross that $150,000 threshold, every single dollar of your catch-up contribution, which is $8,000 in 2026, must be made on a Roth basis. That means it is funded with after-tax dollars. You no longer get the upfront tax deduction. For a dual-income household where both spouses are aggressively saving for their final years in the workforce, losing that pre-tax deduction could instantly increase your current tax bill by thousands of dollars. Here is the payoff, the way you actually navigate this. First, you must immediately check your 2025 W-2. The IRS isn't looking at what you make this year. They base this mandate entirely on your prior year wages. If box 3 of your W-2 from last year shows even $1 over $150,000, your HR department is legally required to force your catch-up contributions into a Roth account. If your employer's plan hasn't been updated to accept Roth contributions, and shockingly, many smaller company plans are still lagging behind, you won't be allowed to make catch-up contributions at all. You need to sit down with your payroll department this week. Confirm that your plan can actually process Roth catch-ups. And more importantly, mentally prepare your household budget for a smaller net paycheck. Your gross pay hasn't changed, but because you are paying taxes on that $8,000 up front, your take-home pay is going to shrink. The silver lining is that this money will grow completely tax-free for the rest of your life. But if you were relying on that deduction to keep you out of a higher tax bracket this year, you need to adjust your strategy right now. Let me ask you something. When was the last time you actually read the fine print of your pay stub? Most of us set our retirement contributions on autopilot a decade ago and never look back. But right now, nearly 70% of older workers have absolutely no idea this Roth mandate has taken effect, meaning millions of Americans are going to get a massive shock when they file their taxes next spring. Don't let yourself be one of them. Now, while the IRS is forcing high earners into paying taxes up front, they are simultaneously rolling out a highly specific, very narrow window for another group of pre-retirees to supercharge their savings. We need to talk about the new super catch-up provision because this is one of the most bizarrely structured age-based rules the IRS has ever created. Typically, the IRS treats everyone over the age of 50 as a single block of older workers. Once you hit the half-century mark, you get the standard catch-up limit. But for 2026, the government has carved out a hyper-specific demographic. Workers who are exactly 60, 61, 62, or 63 years old. If you fall into this exact 4-year window, you have just been granted access to the largest contribution limits in the history of the American retirement system. The tension here lies in the ticking clock. If you are 59, you don't qualify. If you turn 64 this year, you age out of the benefit entirely. It is a strictly enforced 4-year sprint. For the year 2026, if you are in that sweet spot, your standard catch-up contribution of $8,000 is thrown out the window. Instead, you are legally permitted to contribute a super catch-up of $11,250 on top of the base 401k limit of $24,500. That brings your total allowable individual contribution to an astonishing $35,750 for the year. The payoff for you is understanding exactly how to leverage this without disrupting your lifestyle. If you are 60 years old right now, you are in the prime zone to shovel an absolutely massive amount of wealth into a tax-advantaged shelter right before you stop working. But remember that rule we just talked about. The Roth mandate still applies. If you make over $150,000, that entire super catch-up amount must be Roth. The strategy here is hyper-aggressive savings. If your mortgage is finally paid off or the kids are entirely off the payroll, take that exact amount of freed up cash flow and redirect it directly into your employer plan. You have precisely 4 years to legally hoard an enormous amount of your own money into these accounts. Do not let this 4-year window pass you by just because nobody in HR tapped you on the shoulder to tell you it existed. Let's transition into what happens when you actually leave the workforce, because the rules around how you file your taxes as a senior have radically shifted for 2026. This brings us to our third major change, the new Senior Bonus Deduction. For the past several years, Washington has been warning us about the expiration of the 2017 tax cuts. Financial planners everywhere have been sounding the alarm, telling retirees to brace for a massive tax hike when the standard deduction was scheduled to get slashed in half. The tension was palpable. Millions of retirees were preparing to be pushed back into higher tax brackets on fixed incomes. But then Congress scrambled and extended the higher standard deduction. And hidden inside that new legislation was a brand new, highly specific tax break exclusively for Americans age 65 and older. Starting in 2026, if you are 65 or older, you are entitled to a new $6,000 bonus deduction per person. This is not the standard age-based add-on we've had for years. This is a completely new structural deduction that stacks on top of the standard deduction. If you are married filing jointly and both of you are over 65, that is an extra $12,000 of your income completely shielded from federal taxation. When you combine this with the extended 2026 standard deduction of $32,200, an older married couple can potentially shelter nearly $50,000 of income before paying a single dime in federal income tax. But here is the catch, and this is where the IRS gets sneaky. The payoff requires you to meticulously manage your modified adjusted gross income. The government rarely gives away a deduction this large without attaching a string. And in this case, the string is a phase-out. If you are a single filer making over $75,000 or a married couple making over $150,000, this new bonus deduction begins to evaporate at a rate of 6%. This means your tax planning for 2026 cannot be passive. If you're pulling money from a traditional IRA, taking Social Security, and perhaps doing a few Roth conversions, you have to watch that income threshold like a hawk. If your income accidentally spikes, maybe you sold a piece of property or you took a larger than normal required minimum distribution, you will silently trigger the phase out. You will lose the deduction, your taxable income will jump, and you will pay more in taxes. You must sit down and model your 2026 income before you take any major distributions. By strategically choosing which accounts you draw from, pulling from tax-free Roths when you get close to the limit, you can preserve that $12,000 shield and keep the IRS's hands off your retirement. Think about this for a second. The IRS essentially created a shadow tax bracket. By phasing out your deductions as your income rises, your effective tax rate is quietly increasing without the government ever having to officially announce a tax hike. It is a brilliant political move, but it is deeply dangerous for your wallet if you aren't paying attention. Have you ever been blindsided by a tax bill because of a phase-out you didn't know existed? It is one of the most frustrating experiences a retiree can face, and it happens every single day. This brings us to the fourth major shift, and this one addresses the single most terrifying financial fear older Americans face: the catastrophic cost of long-term care. According to recent data, someone turning 65 today has almost a 70% chance of needing some type of long-term care services in their remaining years. The financial tension here is unbearable for many families. Long-term care insurance premiums have absolutely skyrocketed. People are looking at their traditional IRAs, realizing they have the money to pay for the premiums, but they are terrified of tapping those accounts early because of the strict 10% early withdrawal penalty if they are under age 59 and a half. The IRS has finally acknowledged this crisis. Starting in 2026, a massive new provision is fully live. The IRS has officially created an escape hatch. If you are under 59 and a half, say you retired early, or you are simply trying to get ahead of the curve while you are still in your 50s, you are now legally permitted to withdraw up to $2,500 per year from your retirement accounts, completely free of the 10% early withdrawal penalty, as long as that money is used directly to pay for premium payments on a qualified long-term care insurance policy. This is a game-changing payoff for early retirees or pre-retirees who want to lock in lower premiums while they are still relatively young and healthy. Instead of paying those massive premiums out of your current cash flow, you can systematically draw it from your tax-deferred accounts. Now, you still have to pay ordinary income tax on the withdrawal, but dodging that 10% penalty means your retirement accounts can now act as a dedicated funding mechanism to protect your future health. It removes the friction of buying coverage. However, you have to document this perfectly. The IRS isn't just going to take your word for it. The withdrawal must be for a strictly qualified policy, and you will need to retain the premium invoices and proof of payment alongside your tax returns. If you have been on the fence about securing long-term care coverage because you didn't want it eating into your monthly budget, this 2026 rule change gives you the exact mechanism you need to protect your family without draining your checking account. We've covered Roth mandates, super catch-ups, new deductions, and penalty-free health withdrawals. But what I am about to share with you next is without a doubt the most dangerous shift happening in 2026. If you plan to retire before age 65, or if you are already an early retiree relying on the open market for health insurance, there is a silent trap door that just opened underneath you. A single dollar of extra income could literally cost you $20,000 in medical bills this year. We are going to break down the terrifying return of the subsidy cliff right now. For the last several years, early retirees have been living in a golden age of subsidized health care. During the pandemic, the government passed emergency legislation that dramatically expanded the Affordable Care Act premium tax credits. They essentially eliminated the income limits. It meant that even if you had a fairly robust retirement income, your monthly health insurance premiums were legally capped at no more than 8.5% of your household income. This allowed millions of Americans in their late 50s and early 60s to confidently leave the workforce without waiting for Medicare to kick in at age 65. The health insurance math finally made sense. But here is the devastating tension. At the stroke of midnight on December 31st, 2025, those expanded subsidies completely expired. We have aggressively reverted back to the pre-2021 healthcare rules. And that means the notorious ACA subsidy cliff has returned with a vengeance for 2026. If you do not understand how this cliff works, it will absolutely wreck your retirement budget. Under the 2026 rules, premium tax credits are strictly capped based on the federal poverty level. If your modified adjusted gross income stays below 400% of the poverty level, which for a married couple in 2026 is roughly $84,600, you get significant financial help paying your monthly health insurance premiums. But the moment your income hits 400% plus one single dollar, you don't just lose a little bit of the subsidy, you don't phase out gently, you fall entirely off the cliff. Your premium subsidies drop to zero instantly. For an average 62-year-old couple, an ACA health insurance policy without subsidies can easily cost upwards of $2,000 a month or $24,000 a year. Let me paint this picture clearly. If you earn $84,600, you might pay $500 a month for health insurance. If you withdraw one extra dollar from your IRA to buy a cup of coffee, bringing your income to $84,601, your healthcare costs could explode by nearly $20,000 for the year. That one cup of coffee just ruined your financial life. The payoff, your ultimate defense mechanism, requires flawless income engineering. If you are under 65, your tax strategy is no longer just about minimizing the IRS. It is a life or death healthcare strategy. You have to meticulously control every penny of taxable income that shows up on your return. This is where your different buckets of money become your greatest weapon. If you need $60,000 to live on and another $30,000 for a new car this year, pulling all $90,000 from a traditional 401k will push you over the cliff and trigger a catastrophic premium hike. Instead, you pull your living expenses from the taxable accounts, keeping your income safely in the $60,000 range, well below the cliff. Then you pull the $30,000 for the car from a Roth IRA or a regular savings account, or by selling stocks with no capital gains. Because Roth withdrawals and cash savings do not count towards your modified adjusted gross income, you get the car, you keep your income artificially low on paper, and you preserve your massive healthcare subsidies. You must treat the subsidy cliff like a physical barrier you cannot touch. Calculate your specific county's threshold, work backward from that number. If you are ever forced to choose between taking a larger withdrawal from your traditional IRA or putting a major expense on a 0% credit card for a few months, you might actually be better off taking the debt temporarily if it prevents you from falling off that subsidy cliff. It is that serious. You are navigating a minefield, and the only way through is to track your taxable income on a month-by-month basis throughout the entirety of 2026. We have just walked through a massive amount of incredibly complex, high-stakes information. So let's ground ourselves and recap exactly what you need to focus on right now. First, if you are 50 or older and made over $150,000 last year, your catch-up contributions are now mandatorily forced into Roth accounts, meaning you need to prepare for a smaller net paycheck immediately. Second, if you are lucky enough to be between the ages of 60 and 63, you have been granted a 4-year window to exploit the new $11,250 super catch-up limit. Do not waste it. Third, the new 2026 tax codes have gifted seniors 65 and older a massive $6,000 bonus deduction, but you must aggressively manage your income to avoid the phase-out trap. Fourth, if you are staring down the barrel of long-term care insurance costs, you can now safely extract $2,500 a year penalty-free from your retirement accounts to fund those premiums. And finally, and most importantly, if you are an early retiree relying on ACA healthcare, the subsidy cliff has violently returned. Going just $1 over the threshold will decimate your budget, making income control your absolute highest priority. I know this feels overwhelming. The rules change, the goalposts move, and just when you think you have a handle on your retirement, the government rewrites the code in the dark. But you are not powerless here. By understanding these 5 changes, you have already taken the most important step. You are choosing to be proactive instead of a victim of circumstance. Your retirement is the culmination of a lifetime of your hard work, and you deserve to keep the money you've earned. I don't want you to just hit a subscribe button and move on. I want to know exactly what you are facing right now. Go down to the comments and tell me, which of these 2026 rule changes is directly impacting your retirement timeline, and what specific steps are you taking to protect your nest egg? Let's figure this out together. Stay safe, stay vigilant, and I will see you in the next video.